So what's going on in the stock market? It had one of its worst point decline days in its history. Guys, I've only made around 10 videos so far, and I think I need to throw in the towel. Well, just joking. So on a more serious note, let's look into this and do some research. So when the stock market goes down, a lot of good deals start to show up. And what's more important than anything is to know what a stock is worth to you. And the reason why it's so important to know what a stock is worth is because there's a funny psychological thing that happens when a stock price goes down. People flee the stock. And when the stock price goes up, people gravitate to the stock. And it's a weird phenomenon, and it's kind of counterintuitive to, let's say, I want to buy this marker, and this marker costs $10. And yes, I buy the most expensive markers available. So let's say the next day this marker costs $7. Oh, that's a 30% discount. Am I going to be like, no, I want to buy that $10 marker? No, that doesn't make any sense. I would buy that $7 marker over the $10 marker any day. I mean, I wouldn't buy the $7 marker because that's way too expensive. But the main point is that if the marker goes down in price, I'd want to buy it. I wouldn't run away from buying the marker and be like, wait, I'll wait for that marker to go back up in price and then pay the $10 for it. Or no, I want to pay $20 for the marker. I can't just pay $10 for the marker. So why is it different for stocks? Well, the one reason why it's different for a stock is that it's hard to understand what the stock is worth. And how do we understand what the stock is worth? Well, we have to do research. We need to look at all the data points, the P ratio, the earnings, the future earnings, and the historical fundamentals of the company, especially the balance sheet. How much cash does it have on hand? What do they do with the cash? Are they able to position themselves to acquire other companies and grow that company? And if a downturn of the economy happens, are they going to have to go bankrupt, or do they have enough cash in hand to be completely fine to sail through that? So it's up to us to research the company, look at these data points. You can look at analysts and read up on the stocks to really find out what a stock is worth to you and figure out what do you think that stock is going to be, what value will that have over time. And if you research a stock and put a value on that stock, then to you, that stock could be like, just what that should be worth, just like an iPhone. If you know that an iPhone should be, it's priced at $1,000 right now, let's say, but you know that it should be only worth, by the manufacturer, like $600 or something, so that you only want to pay maybe $700 for it. So you know what you want to pay for, and you'll wait for that deal because you know that they can cut in that margin when they really need to sell it once the next model is going to come out. So you know that from top to bottom, but then for a stock, it's different. But it just takes the research to figure out what that is worth. So let's go into what actually happens in a stock market crash and see what it's like to be a buyer and how long it takes for your stock to become profitable again. So let's look at the S&P 500. So it's been following this clear support trend line here since the financial crisis, and it's been bouncing off, and I knew that it would have a really good probability to bounce off again in December, and took advantage of that as a good buying opportunity and thinking that it might hit support there, and in fact it did. So an interesting thing there is that it's just good to know that this line exists. This is just to help to know that historically we have bounced on this, so maybe in the future it will also give support. We don't know, we'll have to find out. But so that's the interesting line there. And I wasn't so surprised also when we started going down recently, because if we look at this trend line, it's also been hitting resistance at these levels here for the past 18 months. And so if we look at this last time it crashed around December, so if you bought any time in December or before that, it was a pretty good buying opportunity. The stock market bounced really quickly in only a few months' time. And you could say that, oh, well, we didn't even have a 20% decline. It was almost 20% decline, but what if it's a really big decline? Well, let's take a look at an example where we had a massive decline. Let's take a look at the financial crisis and see what we could have done and practical steps we could have done in terms of buying, and see how long it would have taken to gain profits from a strategy that we can implement in the future and maybe even in this decline that we're looking at right now. So this is the financial crisis. Let's say in the first little dip here, we bought it, and let's be modest. That's not saying we can predict all of these bottoms. So let's say we bought at 135, and this is the SPY that we're looking at, and 125 there, and 90 here, and 75 there. And the total divided by 4 would have been $106. So that's if we bought 4 equal purchases at these dips. The average price we would have is 106. In late September of 2009, we would have made a profit since then. And I hope this gives you perspective of crashes and simple strategies you can take and understanding what its intrinsic value of the stock is. And a friendly reminder that I'm not a professional financial advisor. These videos are for your entertainment purposes only. Thanks for watching. And don't forget to like and subscribe if you want more content like this.